Of Fident Asset Management joining us. Aishwarya, good buying interest in the markets coming in. Nifty above that 24,900 on the back of some relationship thawing which is expected on US-India front. What are you expecting? What can the next moves be, given that today we are seeing some export-oriented themes also back in action?
Good morning, everyone. Lavisha, nice to be here. So basically what has happened, if you see the last 1 week, Trump has commented about India in at least 3 tweets and with a positive bias. And possibly this is the conundrum which market was trying to struggle with over the last 3 to 4 weeks, has basically getting some respite or breathing space. That's why we have seen that kind of rally momentum which is picking up in the market over the last week or so. But at the same time, we have to also understand that if we look at how India has done compared to other emerging markets, that doesn't look out a very bright story. India has allocations or the holding of the overall emerging market MSCI index has fallen from almost 20% to 16%. And the reason for that is if you see how India has done compared to other emerging markets, equities, where majority of the index, if you see the last 12 months, they are up almost 15-16%. India is actually negative -2%. And on this is all on account of the kind of FI outflow which we have witnessed, especially in this calendar year so far. I think we are almost closing to $16 billion of outflows. And that's all because of the uncertainty or the geopolitical risk all associated with the Indian tariff. We've also seen that impact on Indian rupee, which almost slide down to all-time low very recently. So to be honest, not on in a very great position from the market perspective, but obviously some signs that which is visible with this kind of communication which is coming is giving the much breathing space to the market. And I believe if we possibly will see at least 25% of that additional thing, if it gets away in the next, say, month or so with those negotiations on around, we can see some better time for Indian equity market before Diwali.
Before Diwali itself, all right. Ashwin, let's also talk about IT stocks because they have been buzzing on the back of the Infosys news and, of course, the Fed rate cut, which could be possible as soon as next week itself. And the street has also been trying to relook at it as a contra-backed. Would you also relook at it or remain conservative until the real growth is visible for majority of the IT pack?
So at Fident, I would say we are running this contra from the last couple of months. We have gone massively overweight on IT. Not many of the market participants are doing that. The reason is obviously like I say, when we have met majority of the management over the last 2 weeks, the one thing which it came out very clearly is that the macro hasn't deteriorated. Deal pipelines are looking very strong. Obviously the deals are more ROE focused, more on cost takeout, but the deal pipeline continues to be robust. Sectors like BFSI, retail are doing very well, and they are not seeing any pressure on any particular vertical except for some logistics or commodities where Indian IT services exposures are pretty low. So the growth in IT, I believe market will be surprised to see that stability which will come over the next 2 to 3 quarters. And on top of it, as you said, now we are very close to Fed cutting rates, right? There's a 99% probability that we will see a rate cut next week. And there's almost like 3 to 4 rate cuts expected this calendar itself. So with the decline in the interest rate, I would say because of stability in the growth, and most important is valuation. So if you see the IT index is down almost 25%, and I believe that is a place where we can create alpha in the coming time. So we are very positive on various of these mid-size IT services companies, and we have gone overweight on account of that. So overall, very positive on IT per se.
Positive on IT per se. Aishwarya, let me get your view on export-oriented themes. Today they are back in action as well, be it your auto ancillaries, textiles, or even for the matter of shrimp stocks as well. All of them are doing well in today's trading session because they're hoping that some trade talks would materialize on that front. But what would you advise an investor to still stay away at this point of time, or how should they position themselves?
Yeah, so obviously when this stalemate is getting some expectations of a solution, sectors which were hit the most are expected to see the bounce, and that's why we are seeing good momentum in textile stock today. and other export-oriented stories. But I believe we are still not out of the woods. Market investors has to be cautious on understanding what kind of businesses they are putting their money into, and whether these businesses have that kind of moat around themselves to settle around any of the negotiations outcome which will come out in the next couple of months. Having said that, we at Fident are very positive at auto SS space. Now, Lois, we have to understand this thing that if we really look at some data points, suppose two-wheelers is one category in auto. And if you look at the data on annual basis for the last 4 5 years, the total two-wheeler which were sold in India before COVID was close to 2.1 or 2.2 crore in an annual number. Right now, even after 5 6 years, we haven't reached that. Last year, we were close to 1.9 crore number. So if I connect this, with the way GST rationalization has happened, I believe this is a very big momentum for the kind of growth that we have seen. When I see the same number for four-wheelers, we are seeing that that number is much higher. We used to sell 35, 36 lakhs of car before COVID. We are almost at 44, 45 lakhs car, which is sold on annual basis in India today. But that number is not there in two-wheelers. So once thesis is there, whether the penetration has really gone to the peak, but we at Fident, we believe that, there is a lot to do with the purchasing power at the lower part of this pyramid, right? And because of this huge benefit on GST rationalization, I believe this is one of the larger reforms which will have a very positive cascading effect in the coming times. So we are very positive on auto. And as you said, like the themes on export side, large part of the export, 20 30% of a lot of these auto companies have a good export business. So I think that will also have a good tailwind around that. But coming to other sectors, I'm very positive on pharma. We believe chemical is one sector which is also export oriented, should do really well when I'm looking at various of these data on monthly basis. And obviously textile, we have to understand how the whole scenario plays out in the coming month.
Okay. Apart from autos, anything else that you're watching out from the consumption space in particular, given that GST reforms is also at the talk of the town at this point of time?
Yeah, so we are as I said, I'm very excited about the whole GST stuff. And I believe one sector which should also benefit out of this is your FMCG, right? If you see the last 3 to 4 quarters, we have seen that rural growth has been pretty strong. At times, it has been faster than the urban growth, thanks to all the private public capex which government has been putting up, higher yield on crops, better your acreages, and better rural income. And at the same time, because of the tax cuts on or because of this budget, we expect that rural economy alongside urban economy is also expected to see growth coming through. And on top of this, we have icing on the cake in the form of GST rationalization, especially on mid and the lower strata, where we believe the demand can revive significantly in the next 4 to 6 quarters. So we believe alongside auto, FMCG is also one play which should do really well. If you have seen the last couple of months, a lot of these large cap or even mid cap FMCG stocks have gone up 15 20% in expectation of that. And we should not forget that FMCG stock has been lagging or lagging behind over the last 4 5 years. So there's a lot of catch up that they have to do, and they have the right ammunition with them to take on that part. So we are very positive on FMCG alongside auto on account of this GST rationalization thing.
Okay. Let's also talk about cement stocks. They have been buzzing on the back of this GST cut news as well, Aishwarya. But do you believe that affordable housing stocks could be the dark horse, given that the construction costs are expected to come down tremendously by about 50 60%? That's what the entire reports have been suggesting.
And yes, we completely believe in that. And if you connect the dots, the continuous focus of government on housing as a space, puts more, fire to the fury. So we believe that housing is a space we should do really well in the coming couple of years. And at Fident, what we're trying to do here is we are trying to play through housing finance companies. If you see their numbers over the last 4 to 6 quarters, there is a remarkable improvement in the ROEs of these companies, right? And they have been putting up a good growth, whether it is like likes of Aptus, Home First, India Shelters, and places like that. And we believe that particular space looks pretty sweet from growth as well as valuation perspective. On other side, because of the element of housing, more than to cement, we are more tactically buyer into say pipes or possibly wires and cables and possibly those kind of space, which are a proxy play on housing. We obviously believe that cement stock, as you particularly mentioned about it, will be the bigger beneficiary of the GST reforms. I've been tracking cement for the last 20 years, and I can tell you the volatility or basically the sensitivity of pricing to the EBITDA and the PAT is very high in cement stock. And most of the analysts will appreciate that these kind of saving on account of GST can really put up a good amount of volume growth, which will flow for your better profitability and growth for cement companies. But there's one element where we make us not go all over the cement is the valuations. So the valuations of the stock has to be seen in conjunction with the growth, and we believe there are better opportunity in other housing based themes which can create better alpha in the coming times for investors.
Okay. Ashwarya, you mentioned a whole host of themes that you've been bullish on, be it your auto or even IT for that matter as well. Any pocket that you're still wary about?
We are staying away from real estate, that particular one piece. In spite, we know that there will be another rate cut possibly, but real estate has been out of our radar since many months. And I think this even the portfolio, see the real estate index is down almost 40-50%. I somehow believe that we possibly, at least on the residential side, we are reaching around the peak of the volumes. All the data which is coming to on Mumbai, Bangalore, and Hyderabad is someone's giving us that this is one area possibly I will stay away. Second is obviously on gold-based, companies. Especially we have seen how the gold prices has moved up. It has almost up 45% in this calendar year so far. And I believe there will obviously have a deterrent impact on the volume growth of many of these gold-based retailers. I'm not talking about gold financiers, but it's more about players like who are into gold jewelry and things like that. So I believe the valuations are pretty staunchy there, and I am not very excited to see whether the volume growth will come. Obviously, there will be price-led growth of 20-25%, but volume can remain, market can get surprised to see volume going down. Our interaction with many of these companies, they highlighted us that people are going down below from 22 carat to almost 18 carat or as low as 14 carats. Studded is still very good, doing good, but diamond prices have gone down. So this is one sector we are completely ignoring.
Okay. All right. All right. With that, we have to let you go, Ashwarya. Thank you so much for your time and connecting with us.
Thank you. Thank you so much.
All right. Let's take a quick